MetaMask, one of the most widely used wallets in the world of decentralized finance, has become synonymous with Web3 access, a simple extension or app that connects millions of users to blockchain applications. But in 2025, its parent company ConsenSys introduced something entirely new, the Mask token. Unlike the wallet itself, which serves as infrastructure, Mask represents the first step toward turning MetaMask's enormous user base into an active, token-based community. The goal, at least as officially stated, is to decentralize parts of the MetaMask ecosystem and introduce incentive mechanisms for users, developers, and liquidity providers who contribute to its growth. The Mask token has been anticipated for years. Rumors of a MetaMask airdrop first surfaced in 2021, following the pattern of other DeFi protocols that rewarded early users with governance tokens. However, ConsenSys delayed the launch several times, emphasizing compliance and user protection. Now that the token has appeared, it marks a new stage in the evolution of crypto infrastructure. Even the access points to Web3 are becoming tokenized. The white paper for Mask and statements from ConsenSys outline several primary functions. The token will serve as a governance instrument, giving holders a say in decisions related to product direction, fee models, and ecosystem grants. This mirrors other governance tokens, such as UNI for Uniswap or ENS for the Ethereum name service. But there is also an economic dimension. Mask is intended to power incentive structures within MetaMask's growing set of on-chain products, including MetaMask swaps, MetaMask portfolio, and the MetaMask Snaps extension ecosystem. These components generate fees and liquidity flows, and Mask can potentially act as a reward or staking medium within those systems. ConsenSys has clarified that Mask is not a share of the company but a utility and governance token. Its holders are expected to participate in decentralized autonomous organization-style governance, likely through a structure known as MetaMask DAO. This DAO will gradually assume responsibility for community-facing products while ConsenSys continues to maintain the core infrastructure and security. This hybrid model reflects a broader trend. Large Web3 companies moving toward partial decentralization, using tokens to distribute influence without surrendering legal ownership or regulatory compliance. The Mask token's distribution is still being finalized, but leaked allocation models suggest a split similar to other major launches. A significant portion reserved for users and community incentives, a portion for developers and contributors, and a remainder held by the foundation or company to fund ongoing development. The expected circulating supply is in the hundreds of millions, with vesting schedules extending several years to prevent early concentration. If executed correctly, this could give Mask a relatively stable base and reduce the extreme volatility that has often characterized new token launches. What makes Mask particularly interesting is its potential position as a gateway token for Web3 access. MetaMask is not a DeFi protocol or a single blockchain, it's an interface layer. This means that Mask could theoretically capture value from across multiple networks, Ethereum, Layer 2s, and emerging chains. If token-based governance integrates deeply enough into the wallet's user experience, actions like connecting to dApps, providing liquidity, or enabling new snaps could generate micro-rewards or governance weight for users holding or staking Mask. There are also competitive dynamics to consider. Other wallet ecosystems, such as Phantom and Rabby, have explored token launches, but none have the same user footprint as MetaMask. With over 30 million monthly active users, MetaMask is the default entry point to DeFi, NFTs, and DAOs. If even a fraction of those users begin to use or hold Mask, it could instantly become one of the most distributed governance tokens in Web3. The challenge is whether that distribution translates into real participation, rather than passive speculation. From a regulatory standpoint, Mask sits in a gray area. Because ConsenSys is a US-based company and MetaMask interacts directly with end users, the team has emphasized that the token is not an investment contract and does not grant profit rights. The stated purpose is governance and community participation. However, as seen with other governance tokens, secondary markets will inevitably assign speculative value, which could attract regulatory scrutiny. ConsenSys appears to be preparing for this by separating token governance from the company's legal operations and possibly basing the MetaMask DAO in a more favorable jurisdiction. The token's launch also signals something deeper about the direction of Web3, the tokenization of infrastructure itself. For years, users interacted with wallets, bridges, and oracles without those components having their own native tokens. Now, as networks compete for liquidity and attention, even the front doors of the blockchain world are being financialized. This raises both opportunities and risks. On one hand, MetaMask could align users, developers, and liquidity providers in a shared ecosystem. On the other, it could invite speculation and governance fatigue if most holders are passive. Early analysis from on-chain data suggests strong interest. Wallet activity spiked after the announcement, with users speculating about eligibility for an airdrop. Exchanges are already preparing listings, though ConsenSys has warned users against scams and impersonators. Given the massive anticipation, the initial market reaction will likely be volatile. But over time, the key determinant of MetaMask's value will not be hype. It will be whether governance and incentives translate into sustained participation and revenue sharing within MetaMask's expanding ecosystem. In the long term, MetaMask could evolve beyond governance to include staking or yield functions tied to transaction fees or liquidity flows. MetaMask swaps, for example, already generates fees by routing trades through aggregators. A portion of that could eventually flow to token holders or be used to fund DAO initiatives. The more utility layers MetaMask builds, the greater the number of touchpoints for MetaMask to become embedded in user behavior. Ultimately, MetaMask is a test case for the next stage of decentralization. It will show whether massive Web3 platforms can gradually turn user communities into tokenized stakeholders, or whether the process simply adds another speculative asset to an already crowded field. Either way, the launch of MetaMask represents a turning point. The wallet that gave millions their first crypto experience is now entering the world of tokens itself. For more insights on MetaMask, MetaMask governance, and the evolution of Web3